Welcome to another video or another episode on my channel. Uh, Last week I spoke to you about something else, and I said this week I'll be talking about the different ways that you can identify if a stock is a volatile stock or it's not a volatile stock. It is not that difficult to do, and today I'm going to show you 5 different ways that you can determine if a stock is volatile or not. Putting things into context before we go ahead, this is not a video determining the direction of a market. So we're not trying to speculate or predict where the market is going. All we're trying to do is find out if the stock is erratic and volatile or if it's not. For my particular strategy of writing covered calls and options, we stay away from volatile stocks as much as possible. And if you're the type that buys options, okay, you want to look into the volatile ones because you need the action. Without the action, you're not making any money. In my case, it's the opposite. We want it to be sluggish and boring. The boring way is the way to wealth, in my humble opinion. Now, without wasting too much of our time, let's get into it. The first way, now I'm gonna show you 5 ways. The last one will be for the geeks or for the mathematical geniuses amongst us. Those that listened to their math teachers in school. The 5th one is for you. I reserve the last one for you. I'm not gonna put it first because if I put it on here, many people are just gonna tune out immediately. All right, so I leave that one for the mathematical geniuses. So the first way is for the absolute layman who has no idea. It takes the most time or it takes the longest time, and it's simply by familiarity. When I say familiarity, I mean it should be a stock that has been in your watch list for a while and you have been watching it. When I say for a while, I'm talking about 6 months, even a year if possible. And what you're doing is you're seeing the range at which it moves. Now, you don't have to check in every day to see where it is. It's just every once in a while you check it and you see, okay, it's here, it's in this range. For the whole of the year, it's been in this range. You can also use a chart or the graph to see where it has been, but it's easier where it has been in it doesn't show you how. You don't really see how it behaves unless you actually see the numbers yourself. So if you check on it maybe every week, once in a week or so, and you see it's within this range, it doesn't go past this number on the high point, and on the low side it doesn't get below this number. That gives you a good idea of how volatile it is. And if it's one that moves from super high to super low, you want to stay away from that. That's one way of looking at it. Hope I'm not back in the sun. Yeah, that's one way of looking at it. That's the first way, familiarity. Okay. The second one is when you use trend lines. I'm going to put a picture up on the screen right now to show trend lines. Now, in this case, there's a common saying in trading. They say the trend is your friend, or your trend is your friend. So you want to put 2 trend lines. One, we all know that when stocks are moving up or down, they don't just move in a straight line. Okay, it moves in waves up and it moves in waves down. Even when it's going sideways, it's still in waves as well. What you want to do is connect the top of the waves and the bottom of the waves. There's 2 trend lines, and it looks exactly like this. And what you're looking at there is, those are just investor biases. When it's hitting the top one, it's called the resistance, because at that point, the investors are kind of backing out, like, I don't want to put any money into it, anything beyond this point, okay? And it tends to go back down. And when it goes down and hits the support, that's the point where investors are also saying, okay, I think it's a good price, I want to get in at this price. This has nothing to do with the fundamentals of the company. It's just what investors are comfortable with. Now, that being said, since we're talking about volatility, before you even get into it, the first thing you want to do is check the fundamentals of the company and make sure they're strong. That's a whole nother course, fundamental analysis on its own, that is not covered within the scope of my channel here. So when you have your fundamentals covered, now you want to look at the trend. You want to look at the volatility, which is what we're dealing with today. So in this, the thinner, the closer the support, which is the line at the bottom, is to the resistance, which is the line at the top. The closer both lines are to each other determines how volatile the stock is. If it's closer to each other, it means it's not volatile. If it's wider apart, it means it's a pretty volatile stock. And you have to put this into consideration that this also depends on the time frame on the chart that you're looking at. So what you would have on a weekly chart might be different from what you have, in fact, will be different from what you have on a monthly chart, and that will be different from what you have on a 5-monthly or yearly chart. So you determine yourself which one is comfortable. I use the short-term one because my trading is usually weekly. I barely do monthlies. It's usually weekly. So the shorter the time frame, the better to see the volatility, in my opinion. Okay. Again, I'm not an advisor. I'm just telling you how I think and why I do what I do. Now that's using the trend, and I believe that's point number 2, is it? Yeah, the first one was familiarity. The second one is trends. The third one is using Bollinger Bands. Now, Bollinger Band is another kind of indicator. The trend lines we talked about right now is an indicator. The Bollinger Band is another type of indicator. And I'll put a picture of that on screen as well so you see what it looks like. Basically, the Bollinger Band tracks the stock itself as it moves. It's a bit of a better tracker than just the trend line. And the top of that band acts as the resistance, and the bottom of it acts as the support. Kind of same way like the 2 trend lines. The thinner the Bollinger Band is, the thinner it is, means the less volatile the stock. The broader or the wider the band is, it means the stock is pretty volatile. That's another simple way of finding that out. Okay, and the picture should be on the screen now. You should be able to see what the band looks like and the way it tracks the waves of the stock. The fourth one we're going to talk about. So let me see if I can do a recap quickly because I'm just doing this off heart. We have the familiarity, we have the trend lines, we've talked about Bollinger Bands. The fourth one will be using a Greek called beta. Now, when I say Greek, I'm not talking about Thanos. I'm not talking about Zeus and Hercules or the or them Greeks or the Greeks as a country or as a people. I'm talking about if you're familiar with options or if you know anything about options, you should know about the Greeks. The Greeks are like the delta, degree of responsiveness, or the degree to which the options change as price of the equity changes. Let's not go too deep into that because people are gonna get lost. Let me try to face this way. I think it's better for the sun. So that is the delta is 1. We also have beta. We have theta, time decay. Today we'll be talking about the beta. The beta is used to compare the volatility of the stock you're looking at to the market as a benchmark. And when we're talking about the market, we're talking about the S&P 500, the Vanguard S&P 500, the NASDAQ, the Dow Jones, the indexes, the Russell 2000 and things like that. But generally, we're talking about the S&P 500. That's the main one. That's the main benchmark most or all investors uses. So if the value of the beta of the stock you're looking at any point in time is 1, it means it has the same volatility as the market, which is good. Okay, not bad. That's pretty good. If it is more than 1, if the beta value is more than 1, it means it is more volatile than the market. And you really don't want to go into volatile stocks like we've said. You're better off just sticking with the market in that case. If the value is less than 1, it means it is less volatile than the market, which is a good thing. Okay, again, we're not talking about whether it's going to beat the market in a year or not, or 2 years or 10 years. We're not talking about direction. We're just talking about volatility. It means it is less volatile than the market if it is less than 1. But if it goes into the minus, okay, you want to run. You want to run so fast, your toes touch your forehead and your heels touch the back of your head. That's how fast you want to run away from any stock with a value in with a beta value in the negative. That is the fourth way of checking the volatility of a stock. The fifth way, which I have reserved for the mathematical people among us, or the people who are more math inclined, looks like this. And it's a simple standard deviation formula. People who are used to studying the population or statistics, they would know more about this as a standard deviation. This is what you use, and when you do the math, you plot in the values, you find the variance, the mean, plot in the values, subtract them, square. I can't go into the details of it now because it's just gonna make some people tune out again. But the people who are who are more math inclined or number inclined, they will know what I'm talking about. And at the end of it, you get a number. That number is always in a plus or minus. So it's not just equal to this. It's equal to plus or minus. Let's say you get 8 as the number at the end of the equation. It means the volatility is plus or minus 8 from the mean of the particular data that you were looking at. So let's say the stock is 25, and you get a plus or the final value number you got is 25. I mean the price of the stock, sorry, is 25. It means, and then you get the final value in the formula. Say you get 4. It means plus or minus 4. So it either goes to 29, which is 25 plus 4, or you subtract 4 from 25, or 21. So the range is between 21 and on the bottom side and 29 on the top side. Basically, that's what the standard deviation is. So there you go. That is 5 different ways that you can determine the volatility of a stock. And I believe there's something in there for everybody, whichever one you're comfortable with. Generally, I use the familiarity one because I don't buy lots of stocks. I don't deal with lots of stocks. Maybe 1 or 2. And even before I get into it, I have it in my portfolio or in my watch list, and I'm watching it for a pretty long time. It's just something I like to do instead of getting into other things. So you pick 1 or 2 or combine everything together. But just remember this: complexity is the mother of inaction. Okay, even if it's one of them that you can work with, you should be fine. That leads me to the end of this video. I don't know what I'll be talking about next week, but I will get something to talk about. It's not always easy to come up with content, but sometime along the week something happens and I always get something to talk about. So until next time, see you then.